These signals will tell you a story before the stock market chart does. Bond auctions are early warnings for shifts in risk appetite, from risk on to risk off. Rising yields typically mean tighter liquidity, which typically means higher volatility in stocks. So you want to watch the bid to cover ratio, you want to watch the stop out yield, and you want to keep an eye on the tail risk and foreign participation. My name is Chuck Whitman, and I build great traders that lead great lives. Traders I've trained have generated in excess of $1 billion in trading revenue and are found at some of the largest hedge funds and proprietary trading firms in the United States. The one indicator that will save your ass. Last week on Wednesday, traders missed this. Don't be one of them. In what seemed like a quiet day with not much going on, the S&P 500 dropped 60 points in just 10 minutes. Out of nowhere. Most traders are blindsided. You can see on Reddit and X and different chats, like people are like, what's going on? Why is the market breaking? I wasn't blindsided because I was watching the bond auction. Seeing the chart here, this is where the market was. The market was quiet, going nowhere. Middle of the day, lunchtime blues. And then bam! This is when they announced the results of the 20-year bond auction, and the market sold off 60 points and worked even lower through the rest of the day. So what is a bond auction? Governments issue bonds to raise money. These are typically auctioned to investors who bid based on the amount of bonds they want to buy and the yield that they demand for the bond. Typically, these auctions are what they call a Dutch auction. In a Dutch auction, all successful bidders receive the bond at the highest yield accepted, which is called the stop-out yield. This ensures uniform pricing and reflects the true demand. So if you were willing to take less or take a lower interest rate and the stop-out yield is above, you get a higher rate than what you were expecting or what you wanted, which is awesome. In a bond auction, there's key auction metrics we want to watch. One is called the bid to cover ratio. The bid to cover ratio is the total bids versus the amount of bonds offered. Now, what's considered a good bid to cover ratio is over 2. 2 is considered to be healthy. In other words, there's twice as much demand as there is bonds being auctioned off. These bid to cover ratios are typically higher for short-term notes than they are for long-term bonds. So when we do these auctions, one of the things we want to think about is that governments are selling different durations of securities. In the United States, they could be selling 90-day T-bills, 180-day T-bills, and going all the way out to selling 1-year bonds or 1-year notes, 2-year notes, 5-year notes, going all the way out as far as 30, 40, or 50 years. Then we have what's called the stop-out yield, which I just mentioned. This is the highest yield that's accepted. If there's a spike in the highest yield in the stop-out yield, this signals a funding stress. This is signaling there's a demand problem, and they have to price the bonds at a much higher interest rate to be able to get the demand to get the bonds sold. Then there's what's called the tail. The tail is a difference between the average yield of auctions and the highest yield. The larger the tail, the weaker the demand. And there's a concept called indirect bidders. So when you go to these auctions, not just anybody can come in and bid. You have what's called primary dealers, and they typically will bid on behalf of certain parties, particularly foreign parties. So there's indirect bidders, and this is where foreigners participate. And if foreigners are not interested, this indicates global hesitation. Last week, there was a bond auction in Japan. Now, one of the themes that I have been talking about trading really for the last 10 years now is I believe the Japanese government is likely going to enter some kind of massive stress, potentially a collapse. And this is because of their policies. Their policies have been completely irresponsible, and they are the example over time. When you act irresponsibly, there comes a moment that the market is going to call you out. It doesn't matter who you are. Doesn't matter if you're the Japanese government, the United States government. There are natural laws that happen in the market around supply and demand, and you cannot just create artificial demand indefinitely. Interest rates in Japan have been artificially suppressed for years while they've accumulated massive amounts of debt, such that they can't really afford for the interest rates to go up too much because the government will go bankrupt. The interest on their debt will be bigger than all their tax receipts. Well, last week they had a 40-year bond auction. This auction priced out at 3.61%, which doesn't seem like a lot, but in Japan, that's really high. Japan had negative interest rates in the short term for years, and in the long end, the rates were like 0.5%. Really, really low. The bid to cover was 2.5, which was the lowest since 2012. But the biggest thing was the tail. It was the widest differential in yield versus average since 1987. This is important because for years now, Because they've artificially suppressed interest rates, nobody wants to buy the bonds. So when the government wants to raise money by selling bonds, the only buyer that could justify that rate was the Bank of Japan, the central bank. So the central bank has been trying to exert what they call yield curve control, where they control the interest rate through the entire duration. And so they've artificially suppressed bonds so that when they have an auction, the only bidder is the Bank of Japan. This is a problem, and it's setting up a dynamic for the Japanese government where either one, the government goes bankrupt, or two, the yen gets destroyed. One of the best trades that we had for 2 years was the Japanese yen collapsing against the dollar and other currencies. It took a break in the last year, but I believe it's got another leg down to it that will link to this. Now, why this to me is that canary in the coal mine concept. These little things with auctions, if the Japanese government gets into trouble where they have bond auctions fail, it's going to be a wake-up call to the whole planet. And it won't just be the Japanese government that suffers. Everybody's going to look around at every bond they buy and go, well, if the Japanese government can fail, could the German government fail? Could the United States government fail? And it's going to be a big problem. So I highlight this because this little auction, it wasn't a big in terms of the amount of yen being raised by the auction, but it was a signal. And this set up the next day, which was Wednesday. Before I go there, you can see here is the 40-year JGB yield, the yield on the 40-year bond. And you can see how fast it is rising. Going back to just 2019, 2020, the rate was under 0.5%. And then here's the bid to cover ratio. And you can see it's the lowest since 2012. This is one of the things you can track. And here's the tail I talked about. This is the biggest differential between the stop out yield and the average yield since 1987. Massive tail. This shows the stress in the market. So one, you really got to keep an eye on Japan. Japan from this point forward is a major leading indicator for global economic health and by proxy, United States economic health. The poor auction in the 40-year Japanese bond then led to the 20-year bonds auction the next day in the United States. This is Wednesday. And on this day, the yield went out at 5.047%. It's the highest since October 23rd. The bid to cover was below 2.5. It's below average of 2.58. It was not good. It wasn't awful, but it wasn't good. But this was enough to create a mini panic. And S&Ps dropped 60 points in 10 minutes after the auction results were released. This is a great example of how auctions lead and markets follow. You can see here is the 30-year bond. Again, it was going sideways, not doing anything. And then when the 20-year bond auction results were released, the 30-year bond got clobbered. So why does this matter? Bond auctions are early warnings for shifts in risk appetite, from risk on to risk off. Rising yields typically mean tighter liquidity, which typically means higher volatility in stocks. So you want to watch the bid to cover ratio, you want to watch the stop out yield, and you want to keep an eye on the tail risk and foreign participation. These signals will tell you a story before the stock market chart does. There's a phrase that one of my mentors taught me, and he said, FX, foreign exchange, is the fastest market in the world. The credit or bond market is the smartest market in the world. And the equity market is the dumbest market in the world. And essentially what he meant by that is you could see capital flow shift rapidly from country to country. The bond market would tell you a story of what was going on. And these things could be happening in foreign exchange in the bond market, and the equity market just keep going up. But just like, I'm totally oblivious that this is happening. And then one day, it's like the equity market actually realizes like, oh shit, this is bad. And it, bam, then it breaks. Even in 2008, October of 2007, the Dow Jones made new all-time highs in the midst of all these mortgage issues, all these credit problems. It made a new all-time high in October of 2007. Dumb. Okay, so that's why this matters. Bond auctions aren't just for economists. They are our market radar. So keep an eye on the Japanese bond auctions. Keep an eye on the U.S. bond auctions, and especially the longer duration. You don't need to worry about the 90-day T-bill. That's fine. We're talking about 10-year, 20-year, 30-year issuance. That's going to tell you if there's stress and a lack of demand in the market. So stay informed and stay ahead. This is the matrix: freedom, possibility, choice. And what day is it? That's right, it's Tuesday. And it's not just any Tuesday, it's Trader Tip Tuesday, where I come to you with tips like this of keeping your eye on the bond auctions to help you take your trading performance to an elite level. I'll see you next Tuesday.